Good morning. My name is Richard Heller. I'm a partner at Thompson, Hine in our investment management group, and I also head our hedge fund practice. I'd like to welcome you all today to the webinar. This is the final webinar in our series targeting issues that focus on the SEC's recent guidance on common compliance issues regarding private funds. Before we begin, a few housekeeping items. Today's program is being recorded, and we will send a link to all attendees within 48 hours of today's program. We are offering 1 hour of CLE for today's webinar, so please be sure to fill out and return the webinar affirmation form. This form can be downloaded in the handout section on your user control panel on the right side of your screen. You'll need to enter a tracking code, which we will be happy to give you at the completion of today's presentation. If you have any questions during the webinar, feel free to use the question box located in the control panel on the right side of your screen to submit questions, and we will answer as many as we can at the end of the webinar. With that, I am delighted to introduce our panelists who will be joining me today. Our panel includes Mike Napoli, Director, Fund Team at Ultimus Leverpoint; Andrew Jones, Senior VP and Director of Client Services at Ultimus Leverpoint; Josh Lefkowitz, a partner at Cohen & Company; and finally, my dear colleague from Thompson Hine, Mark Miner, a Senior Counsel in the Investment Management and Business Litigation Practice. So, let's get started. We'll have our first question going to Andrew. Andrew, the SEC appears to be focused on conflicts related to inadequate disclosure of shared expenses. What types of expenses have you seen that private fund advisors might want to pay particular attention to?
Thank you, Richard, for the question, and thank you, everyone, for joining us today for this webinar. So, what we typically see as an administrator at Woodfield are, for the most part, advisor compliance expenses that should probably legitimately be just an expense of the advisor. A lot of times tend to be allocated or misallocated to the fund by some of our clients, and in most cases, this is a an honest mistake. This isn't something that that is malicious or anything like that. But oftentimes the way it should be looked at is that investors expect the advisor to be compliant in order to operate the fund. And getting compliant or continuing to be compliant should not be an expense of the fund, but rather an expense of the advisor. And so this seems to be kind of the most common issue that we see amongst our clients. It's there are going to be other expenses that may not be adequate expenses and legitimate expenses of the fund, but a lot of that is going to be determined based on what's in the offering and what's actually been spelled out in the operating agreement. One of the perhaps a story that kind of gives a little bit more light around this. We had a client on the West Coast that this was maybe 5 or 6 years ago, came to us on a weekend and was very concerned and upset and said that their compliance consultant was resigning because they had misallocated their expenses to the fund. And obviously that was a big concern for the advisor. They didn't feel like they had done anything wrong up to that point. As the administrator, our immediate reaction is, okay, we need to dig into this and find out what is going on here, because this is a big concern. If your compliance consultant is saying, I don't want anything to do with this anymore, that's an issue. So we ended up digging into it with the client. The compliance consultant did resign. The CFO was worried enough about what had happened that they ended up resigning as well. And, we dug into it. They hired a new compliance consultant. What it ended up being is that a number of expenses that maybe shouldn't have been applied to the fund, many of those being compliance-related expenses, had been. And then also going the other way, believe it or not, expenses that were legitimate expenses for the fund hadn't been applied, and were being absorbed by the advisor. So it was going both ways, and in the end, it was just it was a poorly mismanaged process by the advisor. It netted out to be an immaterial amount, right? It was maybe, on a few $100 million fund, I think the amount was about $100,000 that needed to be, reallocated. So it wasn't a huge amount in the end. But this emphasizes the importance of having good policies and procedures in place at the advisor, to basically ensure that, you have a policy that you're going to follow, a way that everyone within the advisor knows, okay, these are how these expenses need to be allocated. This is what is an expense of the fund, and this specifically is not an expense of the fund. In the end, the new compliance advisor basically said, look, you've proactively as an advisor gone about this, figured it out, fixed it, so that when you do come up and if you do have an SEC audit, this will actually end up being something that should be in your favor, because you can show the SEC now that you proactively went about this, fixed the problem, did right by the investors, and in the end, it ended up not being that large of an issue anyhow. So it was, an experience that started out with kind of this very, abrupt call on a weekend, and everybody being very concerned, and everybody feeling like, oh my God, fraud may have been committed here. And it ended up that it was a positive event for that client in the end.
Thanks, Andrew. Any other panelists have any thoughts to add to that? Okay.
Andrew, quick question. How was it discovered, or how did you find that entire classifications of expenses that should have been included were kept out? Were they inappropriately categorized, or what did you find there?
Yeah, so what had happened is the compliance advisor had been working with the advisor to get them, basically, I think filing certain things with the SEC to get into compliance. And on our end, our accounting group noticed that those charges were then being passed through the fund. We notified then, the fund management and the advisor that, well, this didn't look like, it was probably appropriate. And I think ultimately, the compliance advisor probably overreacted with their kind of abrupt, we're going to resign, we think this is fraud situation. What I feel would have been more appropriate is for them to say, okay, we agree that's not correct. Let's dig into this and take a look. It was a very abrupt reaction that I don't think was needed or necessary, but it was ultimately, it was our accounting group that noticed these fees being passed in through the fund, and we kind of raised our hand and said, well, we're not sure that this makes a lot of sense. It was also, importantly, a fund that we had taken over that was being done internally from an accounting standpoint. And so some of this had been done prior to us being the administrator, right? So it was kind of, in a review of all of that activity that had taken prior to our engagement as well.
Thanks. Great. Let's go to our second question for Mike. Mike, the OCIE also criticized expenses charged to clients that were not mentioned in the operating agreements. What types of expenses should firms be aware of, and how can they avoid these types of issues?
Thank you, Richard. Yeah, so, good question. I think, to piggyback off of, what Andrew the story that Andrew kind of told, I think especially the more recent funds that have launched, the offering docs and the limited partnership agreements are getting more and more detailed on exactly what expenses can flow through the fund and what cannot. I think I can tell you, for almost all of the clients that I've worked on in the past and currently, our team goes through a pretty detailed review on a quarterly and annual basis of all kind of intercompany schedules that come from advisors in which they're charging fund level expenses, and we give a detailed review of all of those expenses. I would say oftentimes the expenses that we run into that may be misallocated, are such fees or expenses like placement fees, where certain limited partners might have a side letter agreement, in which case, they opt or mention, not being charged or paying placement fees unless it's in, a management fee offset, which I think we'll get into later. Another area where we see some misallocation of expenses is, at the fund level are deal-related expenses, in which case co-investment vehicles may be invested in that deal as well, and those co-investment vehicles might not be getting their pro rata share of those expenses, and the full amount of expenses are going to the fund. Another good example of expenses that may be misallocated, that we've seen on clients is also interest expense in regards to line of credit. So obviously many funds and many advisors utilize the line of credit to make investments, and they hold, a fairly large balance on that line of credit, in which is, in which interest expense is getting, accrued on a quarterly basis. There are investors that don't participate in the line of credit, in which case they should not be getting charged that interest expense. And, and this interest expense could be, generally speaking, it's the largest operating expense of the fund. So it's very important in those circumstances, that we are not allocating these expenses to those partners that are just not participating on the line of credit. Those are probably the biggest expense areas that I've seen that oftentimes get misallocated. But similar to what Andy said, even when those situations occur, we usually advise or advise the advisors to, if there's any questions, being proactive, working with either their legal team, the auditors, us, to understand how to allocate these expenses. Because in the event that, they are audited or investigated by, a regulatory body, they have a track record of how they went about, deciding what is a fund level expense and what might not be a fund level expense. It shows that they're being proactive. There's no, deceit or ill intent on their behalf to, push expenses through to the partners that they should not be. But, generally speaking, there's generally a very detailed review from a third party, the fund administrator on how they are allocating expenses, the classification of expenses. Again, usually in the offering docs, there's a very, very long list or big section of, what classifies, a T&E expense or a travel expense or an org cost. The legal docs, purposefully probably make it, up for some type of interpretation. So we generally encourage our clients and, the advisor to have these conversations if there is any, kind of ambiguity or hesitation in how they want to treat, these certain expenses. We always kind of advise, being a little bit more conservative than not when it comes to this stuff, and charging fund level expenses. But just always making sure that there's that dialogue between the administrator or the auditor or the legal team and the advisor on kind of what they're pushing through. In the events that we do push an expense through, or the advisor pushes an expense through that shouldn't be, addressing that in a future quarter or even year, and just reallocating that expense. Not even necessarily doing retroactive true up or restatement, but being able to kind of reallocate that expense. Generally, our auditors are okay with that. They'll sign off on that. Again, as long as the intention of the advisor is not to be deceitful. I haven't seen any issues, even when there has been cases where we've misallocated expenses.
You know, I have a question. Do soft dollars ever pop up in that regard?
I'm sorry, say it again, Richard.
Do soft dollars ever enter into that issue?
You know what? You caught me on soft dollars. I'm not sure what soft.
Oh, never mind. Never mind. Mark will get to it later. Mark can explain everything.
Okay.
Well, Richard, I just to add something in here. I mean, I think the key to all of this is really that, you know, if you do go awry here, to bring it back and right the ship, right? I mean, it's a lot of times, as Mike said here, it's not intentional. You're operating a business. A lot of things are going on. There's a lot of, you know, investments, activity, all of that happens very quickly, and things have to move quickly usually. And so you're operating a business. And so if after the fact we notice, okay, something wasn't applied appropriately, the key there is then that we rectify the situation and we fix it going forward. And in a private closed-end fund, you know, we can do that, as Mike said, in a subsequent period, and it doesn't have an impact then on any investors having gotten out of the fund, right? So I think it's, you know, and Mark and Richard, I'd be interested in your opinion, but to me, it really seems that the key here and the big lesson is that if you do identify it, do something about it right away so that you can show that you were proactive and you did the right thing to make sure that the investors were treated fairly.
Yeah, I would agree with that. I think substantial compliance, even if it's a little belated, is really well regarded by the OCIE. I had mentioned this to Mark earlier. A few years ago, 4 or 5 years ago, I was on a committee in which the number 2 guy at OCIE was a panelist as well. And you know the old expression, "Hi, we're from the government. We're here to help you." They actually are. And so when they come in, they see something, and they see that you have found something and corrected it. It goes a long, long way.
Yep.
So I would, Mark, you agree on that?
Absolutely. You know, what the story that you told early on, I think, was particularly instructive. OC is not looking for perfect compliance. They love it when they find it. The only thing I was going to add on to what Andrew said, he's really already teed up, which is an appropriate response to issues that the institution finds that they are handling internally and acting on are more important, quite frankly, and them looking for something perfect out of the box. It's where an institution notices red flags and fails to address them that they end up with issues on the back end. So I agree 100%.
That's great. Moving on, this one is for you, Mark. The risk alert also specifically mentions fees charged in excess of contractual limits, including legal, regulatory, or travel and entertainment expenses, hence my soft dollars mentioned. What advice would you provide to funds to avoid these types of violations? Whoops, we're losing you there.
Hear me now?
Yeah.
Gotcha.
Yeah. First, I think institutions should look to the controls that they have in place. So with adequate advice from a consultant or an attorney, you're going to have a framework from which to analyze the sufficiency here. Now, specifically, these particular call-outs in the risk alert are the types of things that probably could have been addressed with the adequacy of controls on the front end. And so some of these decisions learned over time. So some of these policies, there is no rule prescribing that. So gifts and entertainment is a good example. The SEC is not going to tell you that, $100 is a de minimis gift, but 500 isn't. What they are going to look to is whether or not you have adequate controls to look for and monitor. think we're getting feedback from someone. I'm having a little difficulty. What I think would be just important is you have to remember that the requirement is that the policy and procedure be reasonably designed to prevent or detect. And so there has to be some effort in place there. I guess the other preventative measure to help institutions avoid these types of problems is having a set periodic review of the rules that are there, such that there may be a review period or standard that you are finding in practice may have been initially sufficient because of a change in business or style or some external factor, sometimes even a regulatory change. What was adequate has become inadequate, and the regulator is going to expect that you have some procedure that is going to be looking at those practices within sufficient time so that it could respond adequately to those changes. Exams is good at coming in with their checklist and finding whatever little hole might be there. But once they find it, they're really looking for whether or not there is a active and ongoing procedure to monitor and whether the controls are reasonably designed based on the specifics of your business.
Richard, you're on mute.
You got me now?
We can hear you.
I'm going to try to stay on track because of the limited amount of time that we have. So I'm going to move over to operating partners, and this question is also from Mark. The staff observed private fund advisors that did not provide adequate disclosures regarding the role and compensation of individuals that provide services to the private fund or portfolio companies. So Mark, what issues do these disclosures present for advisors?
So here again, I guess I should remind folks as questions are coming in, we started just a few minutes before, so some of you may not have heard that we're going to be saving the Q&A for the latter part of our presentation. We certainly want to save adequate time to respond to questions. If they're hot or on the particular topic, we'll kind of throw them in as we go along. If you look on the bottom right of your screen, you will see a questions box where you can type in a question. We'll make sure to work them in. Operating expenses, if you look at the risk alert, operating partners gets very little time, a few lines. But it is worth noting the risk alert categories where the SEC has said that there are no policies relating to the topic or those where there are inadequate disclosures. Here, the topic is raised in the context of any instance in which investors could potentially overpay. And the conflicts of interest here is that there might be individuals who are related to or providing services or ancillary services to the institution. And so here again, I think that you start with controls. Institutions may have investments with or other financial engagements or affiliations with some of these institutions. In the risk alert, they have mentioned that there may be a situation where that raises a conflict in and of itself. I should also note, and we mentioned this in a prior webinar, that this is a particular call out that OC has mentioned in prior risk alerts for private fund advisors. So as you are looking at your controls and the policies and procedures related to your institution, you should have a separate category where you're asking, are there institutions with which we are affiliated or do business with for whom there may be those specific conflicts, and have a procedure to review and ensure that those relationships are known and the potential conflicts well laid out, and then adequately disclosed in the proceedings. I take that from the fact that there weren't a whole bunch of examples that this isn't a problem that's ripe for abuse, but it was enough to mention. And so if you have those controls in place, that should go a long way.
Excellent. We're going to move on now to valuation, and this one's for you, Joshua. The OCIE staff has focused its inquiry on whether private fund advisors pay sufficient attention to valuation methodology, and specifically mentioned management fees and carried interest as problem areas. How should funds approach valuation issues to avoid this scrutiny? Is GAAP or another approach preferable?
Yeah, so I mean, I think from a best practices perspective, probably the easiest way to handle this is to follow GAAP. So if you're having audited financial statements done in accordance with US GAAP, then the valuation measurements are going to be reflected as fair value, which is, you know, very well defined at this point in the industry. And there are very well established methodologies for deriving fair value measurements. Now, there can certainly be, you know, widespread debate and subjectivity around assumptions that go into the methodologies. You know, we're dealing with private company valuation measurements, so it's not, you know, as simple as go to the market and see what the trading price is. So there's lots of subjectivity around assumptions, but under generally accepted accounting principles, it is very well established in terms of what are appropriate approaches, appropriate methodologies within those approaches, and the overall concept of fair value. We can get into that a little bit more detailed if we want to talk about that now, or so I see Mark nodding his head, so I'll keep going. So fair value under US GAAP, again, like I said, very well established. It's conceptually, if you think about what an exit market would look like, what could we sell the asset for? What could we sell the investment for? Conceptually, we're thinking about market participants. We're not thinking about what the individual investor paid. That could be an input, that can be an assumption that we look at, but if there were deal-specific criteria in a certain investment, that maybe it was a distressed asset, or you know, it wasn't taken to market, so we don't know exactly what the market participants would have done if there wasn't a process around it, then that can add complexity. So we're focused on what do market participants behave like, what is our principal market? So again, you know, just thinking about, because it's an easy example, assets acquired in bankruptcy or a distressed environment, that may not be the principal market. We may need to rethink about what and how those assets were acquired, and does that represent fair value? So again, you know, following GAAP, well-established methodologies under the fair value concepts. One thing I would, you know, sort of throw out there for everybody participating to at least have some understanding of. You don't have to be an expert in it, but you want to have at least an understanding. There was recent guidance provided by the AICPA around private equity and venture capital investments. There's some good material in there, specifically related to just a couple things that I'll go into that I think are really important. For years, there was this notion of using option pricing models around valuing investments when we're dealing with multiple layers of particularly preferred stock. If we're invested in, you know, Series A and there was a recent, you know, Series D investment, you know, the option pricing model is one methodology. There's been a little bit of less reliance around that option pricing model. It still is the right methodology in certain instances, but it isn't the end all be all as it used to be. And then a concept around calibration of your investment values. So if we have identified certain comparables, whether it's public companies or private company transactions, and particularly on the public company side, where this is pretty straightforward, is if we've identified a set of comps at our acquisition date, and we're going to calibrate to those investments, to those entities, and we're looking at the valuation 6 months, 12 months later. How have those companies performed? And using that as at least, again, an input into our analysis. If they've all gone up 25%, we should be able to explain why we think our investment is staying the same or going down by 25%, vice versa, and probably more relevant, right, in terms of overvaluation. If the market has gone down 25%, we better have really good evidence around why our investment is going up by 25%, if in that scenario. So I'll pause there because I know I've thrown a lot there. See if anybody else has any other comments or anything we want to dive into more deeply.
Andrew, Mike, you got any thoughts? You're on mute, Mike.
There you go. Yeah, I think one of the, the clients that I work on in some of the experience, it's fairly limited in terms of the actual valuation process, the inputs that go into the valuation, especially of the privately invested investments. But one of the things that I had noticed in the past, especially, is that when a private investment is first made, the valuation team or the deal team, they love to keep it at cost for like a long duration of time, almost like up to a year or so. And I feel like, valuation committees or consultants are sometimes like, hey, listen, that practice, that's not, best practice. And we need to start looking at comps or other inputs and to see if the valuation of the, early investment has actually changed. But would like to, get your thoughts on that too, Josh, if, on that scenario.
Yeah, that's a great point. Thanks for bringing that up, actually. So, we generally think about, particularly if we're talking earlier stage companies, it's going to be a little bit more of a longer window. And by longer window, we're generally, as a firm, sort of looking to like 9 months is probably the longest that we like to see. And even then at 9, when we're talking, 6 to 9 months, we want to have at least some understanding around, what's going on with the company, to the extent that you've got information, what is changing, is the investment performing the way you expected? But these are generally long range investment horizons. So it's not, 3, 6, 9 months, holding something at cost. Again, conceptually, we're usually thinking cost as a default for fair value. That probably makes sense inside of that 9-month window. Once we get outside of that 9-month window, we're generally challenging that and saying it may very well still be the cost of your investment represents fair value, but we've got to put some work and some effort into getting there. It can't just be a default. Certain asset classes that we're looking at, we do a lot of things in the digital asset space. That asset class in particular, 9 months is a lifetime. So we're looking more like maybe it's 3 months, it's 6 months, and then because of the volatility in that asset class, we may be pushing back a little bit more. It also depends, if we're talking about a minority venture style investment versus a controlling, traditional private equity investment where we have control over the enterprise. Those types of things, there's going to be more information. It's a little bit easier, more well-established company in terms of identifying comps. So, there's a lot of things there, but yeah, cost is only equivalent to fair value technically, for the day that you made your investment, right? Valuation is as of a specific point in time. But we all sort of acknowledge that, particularly private company, earlier stages, when we get down into the venture capital world, you know, that 3, 6, 9 months, you know, it's probably a reasonable approach to take. But after that, it's, you know, so it needs to be done cautiously at that point.
Josh, I have just a question to throw out there for you. When do you see managers deciding to engage with a third-party valuation agents versus, you know, sticking with doing it, you know, into that internal model and basing everything on what they're doing themselves?
Yeah, so my experience, and hopefully this doesn't ruffle too many feathers, but, you know, my experience is it's generally the auditor sort of pushing the client to go down that path, where the auditor isn't comfortable because of whatever's going on in the investment. It's either got some particular challenges, or it's been, you know, 18 months or 2 years that they've held the investment, and the investor doesn't really, you know, feel comfortable for whatever reason. Maybe it's complexity, whatever the situation may be, to do it internally. You know, that's usually my experience, where there is some movement, some pushing towards using an external resource. So it depends on the sophistication level internally, the amount of staff, right? I mean, these things take time, and people have day jobs, right? So, you know, it may just be a function of, you know, we don't want to expend the hard dollars, right? But going back to soft costs, maybe a little bit different than what Rich was thinking about, but, you know, the opportunity cost of, you know, yes, there's no real investment if we can handle it internally, but we may be overtaxing our staff, or we may just not have, you know, sufficient resources to get it done in a timely manner, where sometimes, you know, from an opportunity cost perspective, it is, you know, it's more efficient, more effective to go external. But, you know, my experience, again, is usually somebody prompting the necessity to bring in an external resource. One other quick comment, again, because going back to specifically overvaluation, one thing I just wanted to touch on really quickly, you know, there is generally within the industry, and there's been some acceptance, again, going back to that private equity venture capital guidance that I mentioned earlier through the AICPA, there's more and more acceptance of, you know, particularly in a multiple tiered capital structure environment, right, where we've got many classes of preferred equity, where we're accepting the most recent round of financing and the price paid as that is the value for all classes, junior to that most recent class. There's more and more acceptance of that. I would still press people in the notion of overvaluation to, you know, challenge those assumptions, make sure there's no differences relevant to terms in terms of conversion rights. Certainly if there's participation rights in the most recent round, that sort of, you know, blows that whole thing apart. But, you know, be cautious. Don't automatically default to the most recent round was sold at, you know, $25 a share. So our, you know, Class A shares are also worth $25 a share. They may be, and in certain instances that makes total sense, but there still are many situations, especially now as we enter into an economic environment where there's been downturn, there may be, you know, distressed investments made, down round investments made. That most recent round may be far more valuable than earlier rounds. So again, in the concept of being careful about overvaluation, I would just, you know, throw that out there as something to be thinking about and be cautious of.
Great. The next question actually goes to both Josh and Mike. What do you do if you discover after the fact that a misapplied valuation methodology has caused an overvaluation of holdings and therefore over collection of management fees?
All right. Well, I guess I can adjust that
You
from
want to go first, Mike?
yeah. Am I on mute? No, I'm good, right?
Yeah, we can hear you. We can hear you. Yep. Sorry.
Yeah. So I think interesting question. So in my experience, in terms of a misallocation or a misvalue of an investment affecting management fees, I'm not sure it affect the calculation of management fees much. From my experience, management fees are usually calculated off of the commitment of an investor during the investment period, and post-investment period, it usually drops down to current or remaining invested capital. So the actual valuation of the investments doesn't have too much of an effect on the actual calculation of the quarterly or annual management fee. It's more based off, again, the commitment, which is a set static number, or the invested capital, which really changes based on sales or investments. Josh or Mark might have a little bit more, from an experience standpoint on valuation affecting the calculation of management fees or over collection of management fees. But generally speaking, from my experience and the clients that I've worked on, the valuation is kind of separate or doesn't impact directly the calculation of the management fee.
Yeah, so I mean, I was going to take it from maybe a little bit of a different approach, really. Okay. Just that again, back to the theme, right, of if you find an issue, go back and fix it, right? That would be the first and sort of easiest piece of advice. If there is a fund structure where valuation does impact management fees and you find that you overvalued something. Now, again, remember, valuation is as of a specific point in time, and there are subjective assumptions that are involved. So, if there's an overvaluation, and the other point too, right? Conceptually, valuation is intended to be done based on information that's known or knowable as of your valuation date. So, we've been dealing with a lot of this relative to COVID-19 issues, right? So, we've told people, and we've generally taken the position, COVID-19 wasn't a known or knowable circumstance for most, companies based, that are driving off of the U.S. economy until March of 2020. Obviously people knew of its existence earlier. I don't think anybody saw the disruption that's taken place over the last 5 months, back in January, February. If you had significant supply chain tied into China, then maybe, right, back in January, because there was a lot of things going on with the shutdown in China back in January. So I throw all of that out there in terms of establishing valuation. If you do find an overvaluation issue, it does impact fees, then obviously fix it like we've talked about previously. The only other thing I would say, and I know there's not 100%, there's differences, right, in terms of practice relative to carried interest. If you're taking carried interest on unrealized gains, then you've got exposure, right? You're going to have people challenge those valuations more frequently than if you're just taking your carry on realized gains once there's an exit. Obviously, doing it on exit is much more simple, much more straightforward, less debate. But if you're taking carried interest on unrealized gains, then I would have very strong valuations in place. I'd be using probably an external provider for those situations, because, and Mark can probably talk about this a lot better than I can, litigation is really expensive, even if you're 100% right. So paying some money to have a valuation done and having that in the file, if you're taking a big carry interest on a fee on an unrealized gain, litigation is going to be far more expensive than having the valuation done by an external service provider. So those are just some of the things I was thinking about in terms of that question.
It's funny that you referred to Mark, because the next question is for Mark. Mark, how frequently should valuation methodology be revisited? Josh.
So this might be a literally answer, it depends. But I think what you're hearing from the collective group, I think, is that a lot of it will turn on the sophistication of what is in the portfolio itself. I think most of the people on the call here today understand the concepts. Let me just step back real quickly. In an evaluation exercise where pricing is relatively known, there's high liquidity, you pick up the phone and you explore price. You can search other avenues. Lots of private interests invest in things that are illiquid, and they build models in order to create or approximate performance. And so lots of things go into these, and so it may depend on what it is that you are trying to value. So we've seen a lot of this over the past couple of years in R&D, healthcare related products, where the valuation of something, there's an arms race to get to a final solution or a vaccine or a particular pill, and one is invested in one company. Those can change overnight because of some announcement or an FDA approval. And so if you have a model built around something like that, you have to be able to bake those things in. And so there really is no fixed number. From a requirement standpoint, a institution that is being reviewed by a regulator is obviously going to want to see that valuation approaches are examined at least on an annual basis. I think that the more sophisticated the product, and you're hearing this from the panelists, the more there might be reason to get a legal opinion or a third-party valuation firm like Andrew mentioned. Sometimes that is as a CYA to the firm. If you have an institution that has an investment committee, a lot of times you will see them increasingly advising that. If you look at the insurance relating to these institutions, or sometimes the D&O, insurance will be asking about whether or not there's an investment committee and the use of these. I think that for carried interest specifically, you're seeing a lot more concern about the carried interest question that Josh mentioned. And so institutions are being much more careful, and I think are using third-party valuation firms to provide that cover for them in the absence of having to go in all the time. Even if you have a model that you built for valuation and a period to revisit it, it does not exist in a bubble. And so there are external factors, again, there are regulatory factors, factors in the market that will move the reasonableness of how quickly you revisit your evaluation. Finally, to Mike Napoli's point, I think there has been an institutional preference to come with some valuation and set it and want some reliability for that for the year. I think there's been some significant compression and pressure on that to revisit that valuation and pricing cycle for very much other reasons that folks have been talking about here today. So I think that the use of counsel or a third-party firm to help with that valuation not only helps you to arrive at a more accurate and current picture of pricing, but also provides some cover for the institution if they're questioned about the valuation question.
So just one quick point, just to delineate, right, and maybe I'm being a little bit of a valuation egghead here, but it's this is what I do. I can't help myself. So keeping in mind, right, there's valuation approaches, which would be sort of like the highest level income approach, where we're looking at cash flows, market approach, where we're looking at what's the market. Then we get into methodologies. There's different methodologies within those approaches that can be relevant. And then within our methodologies, we've got a variety of assumptions that are baked into those methodologies. So your approach may be totally fine, but maybe your method should change based on changing circumstances, or maybe your method is fine, but your assumptions should change based on changing circumstances. So, it's not a matter of just going, is the methodology right or is the approach right? I think you have to be thinking about it at all of those levels, right? I mean, you can pretty much always say a discounted cash flow model is appropriate in 99 out of 100 times, because the assumptions are such, there's such flexibility around that methodology that you can make it work. So then the question goes around, are your assumptions relevant and reliable? And so just for the audience, right, I think we want to be thinking about those things, that we're not just looking at the market. Going back to what Mike was talking about as cost, using cost as your fair value is really a market approach, right? It's what the most recent round of market-based investors paid. Okay, well, has the market changed? Has the company changed where there hasn't been market activity, but now an income approach is much more relevant because our cash flows are far different now than when the last market activity was? So those are the kinds of things that I'm thinking about from the valuation perspective.
Well, let me get to the next question. Again, it's for you, Josh, and Andrew. How might firms respond if they encounter client assets for which their disclosed valuations methods cannot or should not apply?
Sorry, I muted myself
Sorry,
there.
yeah, no, I was on mute as well. Josh, do you want to go first, or?
Yeah, I mean, this is a tough one, right? Because again, the methodology, there's only so many methods, right? There's only so many approaches.
Right.
And
Right.
generally we're going to be focused on income approach or market approach. So to say the methodology is not appropriate, I mean, I think we're generally coming back to this concept of, when is the cost of our investment no longer fair value? I think that's probably the most relevant issue around this concept. Yeah. And we've kind of, we've beaten that horse a little bit. So I'll pause there. If Andrew, if you're thinking of anything else, certainly, and if Rich, if I'm missing something, feel free to poke.
Yeah, no, and Josh, I mean, I agree. That's, typically what we hear in the beginning of a fund's launch is, we want to hold everything at cost, and that's the way that a lot of funds wanted to do things and did things for many years. And so I think it's probably most relevant there. But, what we're looking for, and I believe what you're looking for, Josh, is, consistency in the application of the model. And, so if something changes, it's really got to be a pretty significant change, that would lead to a model needing to be revised. We always advise our clients that, look, if you're going to use an internal model, you really need to make sure that you've gone through and you've vetted out every reasonable situation that could happen, and then you need to sit down and go through it with your auditor and make sure your auditor agrees with you. Whenever we get into a disagreement as the administrator, the accountant, if you will, for the fund with the fund's advisor, we turn around and we say, well, let's call Josh, because he's going to be able to tell us if he's going to sign off on this at the end of the year or not. In most cases, we operate like a CPA firm in the way that we approach, our process on a quarter-to-quarter basis for private funds. So, from my perspective, it's more about making sure that those models are being applied consistently. And if for any reason the manager feels that there is some kind of discrepancy or need for a change, it's really kind of got to be an all hands on deck. Everybody agrees. Okay, yeah, you're right. Something significant has happened, whether that's COVID or whatever it might be, that requires this change to the methodology. I don't see it very often, and I don't think it's something that most advisors are going to deal with on any kind of a regular basis.
We're getting close toward the end. Let me ask one last question before we open it up, and that is to Mike. Mike, OCI criticized advisors' receipt of various types of portfolio management fees. What are some of the major pitfalls to look out for?
Yeah, so I think, again, as time progresses here, this becomes more and more of a hot topic, with the clients that I work on. Generally speaking, the fund team works very closely with the management company team in figuring out the contracts for the special fees that the management team or advisors is collecting. Making sure that we do our does the due diligence and receive documents these contracts is critical to knowing how much we are offsetting against the management fees. The actual offset against the management fee on the fund side is obviously it's dictated by the offering docs or limited partnership agreement. There are some clients that have funds where 50% of the special fees that the advisors receive is offset against the management fees. I think as the LPs get a little bit more savvy and there's this kind of push to customization, you're starting to see more of our clients and our funds have 100% offset of these special, transaction fees, advisory fees go against the actual management fees. So, I think obviously, very, very important for the fund teams anyway to work closely with advisors and management to understand exactly what special fees the management company or the advisors are actually receiving. So we know what to offset, again, at the fund level against the management fees. Best practice is on a quarterly basis when calculating management fees. We have a discussion with the advisors and or the management company team doing the books and records for the advisors on any changes to these special fee agreements, new special fees that may have popped up because new investments have been made. So again, very kind of a high risk area. We take as kind of service providers, we take extra due diligence in making sure that we are accounting for all of these special fees. At a very detailed level, we're offsetting that against the management fees. Again, it's kind of an overall topic of this conversation. There are fees that may come about that we miss in certain quarters of calculations of management fees. Again, just being proactive and making sure we true that up in future quarters or future management fee calcs is something that we do, fairly religiously. But again, being proactive, making sure that we're having those conversations with our advisors about, these special fees, and we're applying that appropriately to the management fees. So the limited partners are getting that benefit. It's a high risk area that we take, extra care and diligence around on a quarterly basis.
Thanks, Mike. I do want to get to one last question before we run out of time, and this is for Mark, because it involves the Code of Ethics and Procedures Manual under 204A. Mark, what constitutes material non-public information, and what types of problems have firms encountered in dealing with that?
So you'll be happy, but not surprised to know that the SEC is loath to provide a definition for material non-public information. The SEC however, has brought lots of actions for insider trading, for which there's context around that. I won't go into too much detail on the definition itself, except to say that the SEC has been mostly focused on how the release of material non-public information or the unauthorized disclosure of that information leads to insider trading. Essentially, what is material is any information that does not belong to the person who discloses it, that could be used or would be reasonably important or be part of that which might inform a decision to invest or not invest. There have been recent changes. We have been relying as lawyers for years on this definition of who holds that information. There was a case, Newman, that has changed that a little bit. It was a Second Circuit case, and then a few layers of those on top of that. What you should probably know generally is that you are required to have a code of ethics. So if you are in this space, you probably already have one, and it's something that that should be revisited periodically. The problems that come up in the space relate mostly to having policies and procedures to protect that information, and none of it is really new in this disclosure. I see we're kind of short on time. I would note that one topic that did come up in this risk alert that did not come up in prior risk alerts is in your description of risks that are posed by the business. And the SEC is looking for your disclosures to discuss whether employees have physical access to information where material non-public information may reside. And there are a few categories that they discuss just in the general definition of where you get material non-public information. It is communication with the publicly traded companies or companies that have non-public information itself. It is related to private investment where there may be some business that will affect a security which could be traded. And so focusing on those two, you want to make sure that at least on an annual basis, which is required, you're revisiting your code of ethics and making sure that there are controls. And then second, they also discuss the personal trading policies that are also required as a part of your policy to make sure that there's a way for your institution to monitor whether employees might be trading on information in ways that are undisclosed to the firm.
Mark, you think we have time for one last question?
Sure.
Okay, Andrew, how does the firm's code of ethics come into play here? You're muted.
Okay, so can you hear me now?
Yeah.
Obviously, the firm should have a code of ethics, and more importantly, should have a policies and procedures manual that everyone is aware of and is signed off on basically how material and things like this, are going to be handled. Obviously, as Mark mentioned, the big issue here is leading to insider trading and issues around that, and even doing something unintentional that could have an impact on an individual. So knowing that you have solid policies and procedures in place, such as restrictions on personal trading and restrictions on making decisions in the fund that may impact something that you also have an investment in personally, whether that be a public or a private placement investment. So I think from a code of ethics standpoint, I think it's pretty on the face. It's pretty self-explanatory that this is something that is important for people to keep mind of. When you're in the thick of it, I think it's easy to forget that this is information that may not be well known to the public, just because you and the people that you work with are dealing with it on a day-to-day basis. It's important to keep that in mind. And ultimately, I think this comes down to a solid set of policies and procedures that everyone knows needs to be followed.
That's great. We have actually. Oh, Mark, are you speaking?
Yes, I just want to say, I know we're at time. We had one question that came in about whether or not, or if we could speak to conflicts of interest surrounding entertaining side letters. And I'll just mention in closing that this topic is a part of the risk alert. It came up and we addressed that in subject number 2. The general consensus of the panel was essentially that the SEC and OC was critical of side letters that were not disclosed that would create an unfair advantage to investors in making their decision to invest. There was unanimous disclosure about whether the contents or subjects or the actual side letters themselves should ever be disclosed. But the fact that they enter into side agreements and the ways in which they might impact those customers is something that was universally agreed should be addressed in order to avoid regulatory scrutiny.
So having reached the hour mark, I think this is what everyone's been waiting for. Do you want to give the tracking code for credit for CLE?
Certainly. So the tracking code, if you are not watching or listening in, is AUG 2020. That's Alpha Oscar Go 2020. As a reminder, the CLE form can be downloaded from the handouts section of the control panel. And so I'd like to thank everybody for their interest in attending the webinar here today. I certainly want to thank our panel who had expert advice for all those who were in attendance. I think if we're following suit, a copy of this webinar will be available within a day or so you can revisit their genius at your will. So I want to thank everybody for their participation. Richard did a great job hosting, and thanks everyone for attending. Have a great rest of the day.
Thanks all.
Thank you.
Thanks,
Bye.
everybody.